Hi everyone, I'm Dr. Muruganandan, Assistant Professor, Directorate of Online Education, Manipal University, Jaipur. In this video, we're going to discuss about formula plans for investment. This topic normally we used to discuss after the portfolio construction. Once we have constructed the portfolio, we are not going to stop there itself. We have to closely monitor the portfolio performance. If the performance of the portfolio is not as per our expectation, or there are many other reasons, of course, beyond that our expectation, we need to revise the portfolio. Then it is not that easy to revise the portfolio because of we have to rework all the things which we have done to construct the portfolio. So it is a very daunting process and a time consuming process, of course, so that it is very difficult for the investors, that too specifically for the layman perspective. Okay, so whenever we want to change or revise the portfolio, the question is what I need to do. Do I want to sell the debt instrument, or the bonds, government bonds, or the corporate bonds at all, or do I want to sell the equity holdings? To answer this question, we have a formula plan. This will going to help us what an investor is supposed to do at the time of revising the portfolio. Not only that, it also helps us to identify when to revise. Okay, so let me see what is formula plan first, and then we will going to see what are the different strategies under formula plan we have to implement. Okay, so what is formula plan? Formula plan consists of predetermined rules which will going to help us to identify when to buy and sell the equity shares or the bonds. Okay, and these predetermined rules normally specify the particular action, or helping us to take the particular action when there is a huge or predominant changes in the equity market. Normally when compared to the debt market or the debt instruments or the debt form of assets, equity shares usually subject to vast volatility, so that the ups and downs in the equity market gives some kind of opportunities to buy, as well as some other time it will give the opportunity to book the profit also. So these formula plans helping us to book the profit, as well as it helping us to invest our fund at the lowest price also. So the overall these formula plans divide the overall portfolio into two groups. The first group is called as aggressive portfolio, where we going to have only the equity and equity related instruments, whereas the another one is a defensive portfolio, where we will going to invest in debt and debt related investments or instruments. Okay, and these formula plans, as I already told, it is a predetermined rules which helping us to transfer the funds from aggressive portfolio to defensive portfolio. Defense depends upon the changes in the market. Okay, so if the market is very high, it will suggest us to disinvest some amount of money in the equity portfolio and move those funds to the defensive portfolio, or otherwise I can say that debt instrument. And if the market is too low, okay, it will suggesting us to disinvest some amount of money from the debt instrument to get invest in the equity assets, so that we can always buy the equity shares at the lowest price and sell the equity shares at the highest price. Okay, so these formula plans are broadly classified into three groups. The first one is constant value plan and constant ratio plan. And lastly, we have Ruby cost average plan, or otherwise we call it as a dollar cost average plan. Okay. So let me see one by one quickly. So constant Ruby value plan. The purpose of this plan is to keep the value of aggressive portfolio as a constant. Okay. Constant value. Uh, I would like to explain this with a small illustration. Let me assume that I will take on 1 lakh rupees to invest in equity as well as in debt instrument, and so that 50% of the money I invest in equity shares, and another 50% of the money I will invest in the debt instrument. So for an easy understanding, let me keep this defensive portfolio in the bank deposit, okay, fixed deposit kind of things. Okay, so whenever the changes in the market, that is in the equity market, beyond certain level, I will going to alter the or I will going to disinvest the equity, uh, or I will take the money from the bank and I will invest in the equity market. Depends upon the changes in the market, in which direction the market is moving. Accordingly, I will going to do that. Okay, so how I will going to do that? Let me explain this. See, for example, if equity portfolio goes beyond 60,000, say for example that at the time of investing, I have invested 50,000 in equities. Let me assume that I invest this 50,000 in 4 shares. Okay, ITC, Reliance, TCS, and L&T. In these 4 shares, I have invested this 50,000. Due to the macro market, movement, these 4 shares also moved up, so that after some period of time, when I'm looking into the equity portfolio, the value of the equity portfolio is beyond 60,000. Let me assume that it is 65,000 on the day when I was seeing my equity portfolio. Whereas my debt portfolio, that is the money I invested in bank, was remain almost 50,000. I have invested, it may be 51,000 or 52,000 and not more than that. Okay, so now this formula plan telling me that my equity value is cross the threshold, that is upper threshold value of 60,000, because in either the direction, if my equity portfolio goes beyond 20%, I supposed to initiate the action, either buy action or sell action, as it is in the upper hand side, that is in the more than 60,000. So I have to disinvest some amount of money. Am I right? So as I already told that my equity value is 65,000. So I will going to disinvest. Let me assume that the 10,000 rupees I'm going to disinvest from the equity, and I will keep that money. I will going to keep that money in bank as a fixed deposit, again back to debt portfolio. Okay, so here for easy understanding, I'm telling that it is a debt portfolio or in the bank deposit. You may invest in debt instrument like government bonds and corporate bonds also. So that what is happening here, when the equity value is beyond a certain threshold, or when the equity market is reaching highest value, okay, due to market condition, I will disinvest some amount of money from the equity at the highest value and keeping that money in bank for the good opportunities. After 6 or 7 months later, again, due to some macroeconomic changes, political changes, or international, the market condition, if the equity value fall down to, let me assume that it fall down back to 42,000 or 43,000, something like that. Okay, I'm not going to take any action in this point, because as per the you know uh, initial stage, if the value of my investment goes below 40,000, only I supposed to take the uh, you know buy order. Am I right? I supposed to initiate the buy order, but already I kept 5,000 rupees at around 10,000 rupees in bank account in addition to the initial investment, so that my total amount of money available in bank is nearly 55 or 56,000, including the interest plus the sale proceeds which I got it from the equity portfolio. Am I right? So it is around 56 or 57,000. Let me assume. So at this point, when my market value of equity shares reached 42,000, which will be beyond the 50% of threshold point. Am I right? 50% plus or minus 20% deviation threshold point. So that in this point, I will initiate the buy order because the market is too low. So there is an opportunity to buy the shares, good amount of opportunity to buy the shares. So I will take some amount of money from the bank and I will invest in the equity shares so that this directing me to buy at the lowest price and sell at the highest value of my equity shares. So this is how even layman investors can make money in the market. Okay. And let me come to the second one, that is a constant ratio plan. This is just another version of the constant value plan only. So in the previous plan, we have kept the values, that is 50,000 in equity portfolio and 50,000 in debt portfolio I have invested. And then I will initiate the buy or sell order with the threshold of 20% deviation. That is, if the equity value goes beyond 60,000 or below 40,000, I will initiate the buy or sell order as per the market condition. Okay, that is what the previous one we had discussed, that is constant value plan. Whereas in the constant ratio plan, instead of keeping the value, I will keep the ratio as constant. Say, for example, 1:1 or 1.5:1 or 2:1. Let me assume that a 2:1 as a constant ratio I'm keeping, so that 2 out of 3 I will invest in equity portfolio and 1 out of 3 I will invest in debt portfolio, okay, or maybe in the bank. Okay, and whenever this goes beyond certain threshold point. See here, I'm keeping threshold point as plus or minus 0.1%. Okay, so if the equity portfolio goes beyond 0.1 or below 0.1, okay, from the initial the constant ratio of 2, okay, I will initiate the buy or sell order like in the previous case. Okay, so that's what we call it as a constant ratio plan, and this constant ratio plan is not much different from the constant value plan. Okay. Yes. Now we will move on to the third one, that is a Thaler cost averaging plan or Ruby cost averaging plan, or otherwise we call it as a systematic investment plan. This is what we small and retail investors used to do in the long run. That too specifically when you invest in equity oriented or equity related mutual funds, you normally prefer to invest in systematic investment plan. Okay, so let me see what it is. So as per this plan, we invest constantly a small sum of money month after month or year after year or quarter after quarter for a long period of time. So that this helps to reduce the the exposure to buy at the highest value and similarly exposed to lose the money, okay, during the downtrend in the market. So here, what we going to do is that yes, we are keep on investing constant amount of money month after month or year after year in at a regular interval. At some point of time, we buy the equity shares at the highest value, and at some point of time, we buy the equity shares at lowest value. But over a long period of time, this will be averaged so that when you look at the value at which you purchased and the value at which your securities are traded in the market, you will get a huge difference so that you will make a good amount of money in the long run. Okay. These are the some formula plans we have, and they give very good suggestions to invest at the lowest point of the market and disinvest the equity exposures at the highest point of the market. But this is subject to this formula plans are subject to some limitations. By knowing those limitations, we will strategically plan certain policies to overcome the limitations of this formula plan. So let me see what are the limitations these formula plans are having. The first one is they are inflexible, means that, see, during 2020, we had seen that market, corrected to a greater extent, nearly 30% it fell down. Am I right? But even the market is deeply corrected, and there are good amount of opportunity to invest in market at the lowest price, but this formula plan does not allow you to do so, because there is a threshold point. You are not allowed to invest beyond certain level. Okay, so that is the greatest opportunity, but we will going to miss it just because of we are blindly following this formula plan. Okay. And these plans do not indicate which security you're supposed to invest in, or which security you're supposed to sold out at the market height. It merely telling you that you have to sell the shares and you have to buy the shares, or you have to invest in equity shares and you have to sell the equity shares. Only these two things it is telling you, and it is failed to give any guidance which security we supposed to sell it or which shares we have to invest in. So for that, you have to do one more analysis. That's what we call it as a fundamental analysis and technical analysis and other things we have to follow to identify which share to invest in and which share is supposed to be sold out at the market height or at the market bottom. Okay. So by knowing these limitations, I hope you can follow the formula plans for the wealth creation in the long run. Okay. Thank you for watching. And if you have any queries, you can write to me. My mail ID is muruganathan.s@jaipur.manipal.edu. Thank you.